Welcome to Donnatella Virtual College, the home of business data analytics, offered and examined by CASNB. Our motto is accessible, convenient, and affordable learning. Remember to subscribe to our YouTube channel. We will take 5 seconds to subscribe. Please let's subscribe before we forget. Okay, now we'll continue, hoping that you have subscribed. We also offer various learning experiences as displayed. For inquiries, enrollment, and additional information, visit our website or directly WhatsApp us via the links provided in the description box down below.
Okay, we'll begin. Welcome to another class. So today we will look at introduction to group accounting, isn't it? Group accounting is one of the topics that was examined last sitting, isn't it? So they examined the statement. So the first question here, this is what was examined last sitting. It was question number 23, isn't it? So under group accounting, we have various adjustments that you may come across. And these adjustments, many of them are very common, isn't it? So the first one is the goodwill computation. Obviously, on acquisition of the NCI, you'll have the goodwill computation, isn't it? So you have to remember that goodwill computation, we have two methods. So we have the partial method and also the full goodwill method. So under the full goodwill method, this is where we incorporate the fair value of NCI. Given a question, for example, isn't it? And in the question, you've been told something on the fair value of NCI was. So just that statement, it will automatically tell you that the full goodwill method will be used, not the partial. And if there is nothing mentioning of the partial on the fair value of NCI, we will use the partial method, isn't it? Then now we'll talk on unrealized profit, isn't it? You have two types of unrealized profit. We have unrealized profit on stock and also unrealized profit on fixed asset. Starting with unrealized profit on stock, this is where there is intercompany sale of goods, isn't it? So, and maybe there are some goods that remained, isn't it? So the unrealized profit on stock equals to the unsold goods you multiply by the profit margin, isn't it? So remember, sometimes or most times the question they will give you in markup, isn't it? So here we said markup equals to profit over cost, isn't it? And margin is equals to profit over sales, isn't it? So if you've been given markup here, isn't it? To change it to sale, remember cost plus profit is equals to sale, isn't it? So you just add the profit to the cost below, isn't it? For example, here, if given a markup of 1, this way, a half, isn't it? Sorry, so I just keep it as a number, then I'll repeat, isn't it? Given a markup of a half, which is like 50%, isn't it? So 50% is like 1/2. So the margin will be 1/3, isn't it? You add the 1 to the 2, isn't it? So the margin becomes 1/3. So equals, isn't it? The margin will become a third, which is 33.33%, isn't it? So the number goes that way, isn't it? Then we also remember we have downstream and upstream sales, isn't it? So downstream sales, this is where sales to the sales are going to from the parent company to the subsidiary, isn't it? Parent to subsidiary, it goes downstream. While if it is upstream, it is the subsidiary selling to the parent, isn't it? So remember, upstream sales, we will debit group retained earnings, debit NCI, and credit group inventory, isn't it? And remember, more or less, group retained earning is like the statement of profit and loss, isn't it? It's like the statement of profit and loss, isn't it? Because everything else, when you add up to the group retained, to the statement of profit and loss, it comes to retained earnings, the last value, retained earnings carried forward, isn't it? So remember, if these upstream sales. So some UPS will go to the NCI, right? Others will go to group retained earnings if the sales are upstream, that is from the subsidiary to the parent company. Then you have unrealized profit on sale of fixed asset, isn't it? So this is where the company are selling fixed asset in group members are selling fixed assets, isn't it? So if group members are selling fixed assets, isn't it? So it generates to what is called unrealized profit on fixed assets. So sometimes, or I personally will reflect that as UPFA, isn't it? Unrealized profit on fixed assets, isn't it? And this one we will be recognizing it as UPS, isn't it? You must remember it. So that's how we'll be going. So the UPFA, this one is unrealized profit on fixed asset, is computed by calculating the transfer value times the profit margin, isn't it? Then remember, isn't it? I just take an example because this one is just like a more of a learning class. I want that the concept is home. These are things. So you have parent company, isn't it? Then you have the subsidiary, isn't it? So the parent has sold some goods to the subsidiary, isn't it? Remember, our PPE account, we always take parent plus subsidiary, isn't it? Our PPE account, we always take parent plus subsidiary. So remember, this is profit, isn't it? So it will, if the asset was sold at a profit, we also included the profit here, isn't it? We included the profit in our PPE. So the first thing we do, we will less it from PPE by crediting PPE and debiting group retained earnings, isn't it? And I've told you group retained earnings is more or less the income statement, isn't it? So here the adjustment that goes to the income statement is you add on cost of sales, isn't it? And cost of sales, remember, are like expenses. If you are following me, okay, DR is debit, then CR is credit, isn't it? This class, you can just ask anything because this is debit, then this is credit, journal entries, isn't it? I think we had a class on journal entries, isn't it? So what I was saying, we less it from our PPE and add it to our cost of sale, isn't it? And remember, because our assets were like, we overstated our PPE, isn't it? So overstating our PPE means it will result to depreciation overcharge, isn't it? We charged depreciation on the profit, isn't it? So we have to remove the depreciation. So by removing the depreciation overcharge, we will debit PPE, then credit group retained earnings. Depreciation overcharge occurs in case of, in the place where there is sale of fixed assets at a profit, isn't it? It will result to depreciation overcharge. Then another adjustment can be revaluation, isn't it? So maybe the books of the NCI were revalued upwards, isn't it? Or were in excess by some value, isn't it? So that is what we call revaluation gain. So revaluation gain, we will add it to PPE because our assets we understated our PPE, isn't it? So we have to add to them so that we state them correctly, isn't it? And we credit revaluation reserve. And so the adjustment here, remember, because we had understated our PPE, it means we had a depreciation undercharge. So we must incorporate in the depreciation undercharge, and it's exactly the opposite by crediting PPE, that is minusing PPE, because PPE has a debit entry, isn't it? Then we have intergroup balances. So intergroup balances, these are owings in between the groups. The one done, are done. So which one is add and which one is less? So like just see assets and expenses, Then we have liabilities and incomes, isn't it? And what you are asking is here under note. So maybe I'll be just writing, then we continue there, then I'll come back here, then I'll tell you. Then this one has a credit balance, isn't it? So we are here on intergroup balances, isn't it? We are coming back here, don't worry. We are under intergroup balances. We debit payables, then we credit receivable. This one will be lessing from both, isn't it? Then we have cash in transit. We debit cash, that is we add to cash, then we credit receivable. This means we will be lessing. And goods in transit, we debit inventory. This means we'll be adding to inventory. Then credit group payables, isn't it? It means we'll be adding to payables. So here is what we are saying. You see, assets and expenses have a debit balance, isn't it? Have a debit balance. So if you debit, you increase because they have a debit balance. If you credit, you reduce, isn't it? Here is what we are saying. You see, assets and expenses, to increase them, you debit, isn't it? To reduce them, you credit. While liabilities, because they have a credit balance, to increase them, you credit, isn't it? And to reduce them, you debit. For example, now here in the intergroup balances, so we always less payables and we less receivables, isn't it? So here, payables are liabilities and are liabilities, isn't it? They have a credit balance. So if we debit, it means we are reducing them, isn't it? To reduce liability, you debit. While receivables are an asset, isn't it? It is an asset. So like when you say you are crediting an asset, isn't it? It means you are reducing the asset. I'll check the chart. Let me see for assets in the debit group retained earnings credit PP, we use the unsold good times profit margin. So unsold good and profit margin comes from only transfer of goods, isn't it? Here for PPE, this one, isn't it? Yes, the depreciation overcharge alone, isn't it? Here we'll be crediting the depreciation overcharge alone, isn't it? And these are the common adjustments. There are no any other adjustments, isn't it? So I think we'll proceed so that maybe when we tackle a question, it will be easily understood, isn't it? So we'll go to the formats. So we have the format of the consolidated statement of profit and loss, isn't it? So the main changes come here under revenue where we less intergroup sales, isn't it? Also cost of sale, we less intergroup sales. We will add unrealized profit on closing stock, isn't it? So let me just show you here. So you see, we said you debit group retained earnings, isn't it? And I have told you group retained earnings are like the statement of profit and loss, isn't it? So here you see we have debited group retained earnings. This is the UPS, unrealized profit on closing stock, because we sometimes have also on opening stock, isn't it? So we have debited group retained earnings. I'll take you back down here. Remember, cost of sales are more or less than expenses, isn't it? So they have a debit balance. That's why UPS we are adding, while unrealized on opening stock we will less. Then we'll add depreciation and a charge, isn't it? I'll take you back to the basic. Here, depreciation and a charge. We said you debit group retained earnings. That is by debiting cost of sale, isn't it? Then so the UPFI will just less to remove the transaction from happening, isn't it? This unrealized profit on sale of fixed assets, we add it back. Then Under investment income, for instance, you have investment income, you will remove the share of dividends and interest paid by investee companies. This will include the joint venture and the subsidiary. Any interest or dividend paid, isn't it, you less, isn't it? Then, so by lessing here, it will be by debiting, isn't it? Then, so the other expenses, then another expense that comes in, it is impairment. So impairment comes in as a result of goodwill computation, isn't it? Then finance costs, profit attributable, you'll find income tax. The others are just the same thing. Then so before, after here, you come to profit here before you go to OCI, isn't it? When you are presenting now, for example, comprehensive income statement, isn't it? So here, the adjustment that maybe becomes very disturbing to people is the profit attributable to NCI. So to calculate the profit attributable to NCI, it will be the reported profit after tax in the subsidiary, isn't it? For example, in this question, where was it? This one we had tackled, but we'll just repeat. So you can see here, profit after tax, isn't it? The NCI reported 140, isn't it? So reported profit after tax in the subsidiary, you less unrealized profit on stock if the sales were upstream, that is from the subsidiary to the parent. You'll also less depreciation undercharge. Then you also less depreciation overcharge. Then depreciation overcharge, you add it back, isn't it? Then you less impairment. So impairment will be only less if full goodwill method has been used. You will now find the adjusted profit where you multiply by the NCI percentage to find profit attributable to NCI, isn't it? So the income statement doesn't have many adjustments. We look at the format of the consolidated statement of financial position, isn't it? So PPE, this is where you less depreciation, undercharge, depreciation, overcharge, you add, isn't it? UPFA, you less. Another thing you'll add here, it is the revaluation gain, isn't it? Maybe I'll just write it there. Another thing you'll add there is the revaluation gain, isn't it? So the investments, this one will be just this parent plus subsidiary. Then you have goodwill, isn't it? This one is a calculation. Also, investment in associate or joint venture is calculated using equity method, isn't it? Then under current assets, inventory, we will less from inventory, we will less unrealized profit on closing stock, and I will also add goods in transit, isn't it? Goods that have not yet been received. Then on receivables, we will less intergroup balances. Then we also less cash in transit. And for cash, we will add cash in transit, isn't it? Then for the share capital, we'll present only the parent, also the share premium. Retained earnings will be as a calculation. Revaluation reserve can be as a calculation, but mostly it doesn't appear. Then you have NCI as a calculation, isn't it? The others is just maybe here on loan stock, you also remove intergroup loans, isn't it? Then payables, you will remove intergroup balances and add goods in transit, isn't it? Then maybe, so the most calculation here is on goodwill, of which goodwill I showed you under the basics goodwill, isn't it? Then the other one will be investment in joint venture or associate is done using the equity method, and which it will be just the cost, isn't it? It can be an associate or joint venture, plus the share of post-acquisition. So profits, post-acquisition profits and reserves, isn't it? Another thing you'll less here is impairment. Then you'll find the net investment that will go to the consolidated statement of financial position. Then you have the NCI. So the percentage of net assets, that is share capital, share premium, revaluation. And then another thing here, it will be goodwill of NCI. That's why we'll be separating the goodwill of the parent and the subsidiary. Then another thing we'll add is the depreciation overcharge. Then we'll less UPS if the sales were upstream, a percentage of NCI, depreciation undercharge, a percentage of NCI, impairment if full goodwill method was used, a percentage of NCI. Then we'll find the NCI carried down, the value that will take to the S of P, isn't it? And then group retained earnings, isn't it? So we'll take the group retained earnings of the parent plus the subsidiary, isn't it? Then we'll take post-acquisition retained earnings in the joint venture, isn't it? Then we'll take depreciation overcharge. Then we take negative goodwill if there is, isn't it? Then here it will be UPS, percentage of the parent, UPFA. So this one only appears to group retained earnings, depreciation undercharge, percentage of the parent, impairment of goodwill to the parent, then pre-acquisition in subsidiary, isn't it? So pre-acquisition retained earnings, isn't it? Let me just make that clear. Sorry. So sometimes instead of doing again the pre-acquisition in retained earnings in subsidiary, you just take here the 80%, isn't it, of the subsidiary pre-acquisition retained earnings at once. So maybe we'll take an example. So we'll start with this one that was examined in the last sitting. So the question reads this way. The following draft financial statements relate to H Limited and its investee company, S Limited and A Limited, for the year ended 31st December 2022. So you've been given there the statement of profit and loss, isn't it? So maybe just right here. So the year is ending at 31st 12 2022, isn't it? Then you've been given the statement, so I will not read the statement. We'll go to additional information. So on additional information, the following details relate to the acquisition, isn't it? So you've been told of the cost, the debt, the company, the retained earnings, profit, isn't it? So these ones are the pre-acquisition, retained profit, isn't it? And then you have the percentage holding, isn't it? So you can see S is a subsidiary, isn't it? While A will be an associate, isn't it? Because it's 30%, isn't it? So like above 50, subsidiary, 50, joint venture, below 50, associate, isn't it? You've been told also H Limited also invested 25 million in the loan stock of S, isn't it? Then on their date of acquisition, the value of building in S and A. So this one will be, so maybe this one will be just on, this one will result now to revaluation gain of what we were talking of, isn't it? Then the fair value, this means that the goodwill will be on full goodwill method, isn't it? Because you've been given the fair value of non-controlling interest, isn't it? Then on January, sold an item of, so this one will result to unrealized profit of sale of fixed asset. I told you the adjustments are very common, isn't it? Unrealized profit on sale of fixed asset, isn't it? An item of planned, isn't it? It will result again to depreciation overcharge. This one will result to depreciation undercharge. Then during the year, the company traded as follows. S Limited sold goods at a selling price of 20 million to H. So you can see it is a subsidiary selling to the holding company, isn't it? So it's an upstream sale, first of all. Then it will result to UPS, isn't it? Then they say a quarter of the goods still remained as that year end, isn't it? Then number two, they say H Limited sold goods at a selling price of 40 million to A Limited, isn't it? The parent selling to an associate, isn't it? That one we don't consolidate, isn't it? So it will be irrelevant. Then at the beginning of the year, H Limited had goods to a value of 10 million purchased from S Limited in the year ended 31st December, isn't it? So this one will result into unrealized profit on opening stock, isn't it? Remember, this one is for the year ended last year because we are dealing on 2022, isn't it? So on opening stock, unrealized profit on opening stock, I'll show you how that one you deal with it. Then included in the trade receivable and payables of each companies are the following intercompany owings, isn't it? Due from H to S Limited 25, due from A Limited to S Limited, isn't it? 25. So we have intergroup balances, isn't it? Intergroup balances. But remember, this one is A and H, isn't it? This one is irrelevant because it's not a group member, isn't it? We only take the group, isn't it? H to S, isn't it? Then we continue. A close check in S Limited books revealed that the receivable of S Limited had 30 million due to H Limited. This anomaly arose because H Limited sent a check of 5 million to S Limited on 29 December 2022, but it had not been received. So it's a check, so it will be cash in transit, isn't it? Meanwhile, all the companies had paid their interest on loan stock, isn't it? So remember our loan stock, isn't it? We had the additional information number 1. H Limited also invested in 25 million, isn't it? So we have intergroup interest paid, isn't it? Of which we must remove. Then additional information number 5 say goodwill where relevant has been impaired by 20% on cost at the beginning of the year 2022. An additional impairment of 20% of the initial cost was again reported, isn't it, on the initial cost. So this one is like the straight line method, isn't it? So at the beginning, so this one was what was accumulated, and this one is so for the year, isn't it also 20% required? Prepare a consolidated statement of financial position for the year ended 31st December 2022, isn't it? So the trick I said here, you first present, isn't it? First present. So H Limited and its investees, isn't it? Consolidated statement of financial consolidated statement of financial position, of financial position, isn't it? So then maybe so instead of again going to repeat everything, you just copy and paste, isn't it? It saves a lot of time. So I'll copy there, Control C, isn't it? And just to inform you, the meeting will go off at 40 minutes. Then I will so we like have 10 minutes left. Then I will again, you just join in via the link. I will again restart on my side, isn't it? Hope we are clear. When it goes, when I'm out, again, we will just restart using the same link, isn't it? So you copy, you come, you paste, isn't it? Control V, isn't it? So after pasting, you can do your own adjustments, isn't it? So investments will remain. So because there was some investment in S, isn't it? So you can add a space there, Control Shift plus, then you press Enter. Okay, they say some cells are merged, then Control Shift plus, Enter, isn't it? You add some space, Control Shift plus, Enter again, isn't it? So another thing that we'll have here is goodwill, isn't it? And also investment in associate. Then I think we'll go to current assets, isn't it? Then the current assets will be just as they are. So here I'll remove the borders there, Alt HBN, isn't it? Then I also remove the shareholders fund. Then I think I'll add another column here, isn't it? Alt Control Shift plus Enter, isn't it? So another column that will be here will be NCI, isn't it? The NCI. Then we go to non-current liabilities. I'll bolden that. So I'm just editing it so that it becomes clean when I start doing it, isn't it? Control bold. I also bolden that, isn't it? I think everything else is now in order. Maybe I remove here one, control minus, then enter, isn't it? So after that, so I'll just first consolidate, because I remember I'm just consolidating the parent and the subsidiary, not plus the joint venture, isn't it? Parent plus subsidiary, isn't it? Enter. Then I'll drag down, isn't it? Remember, I'm dragging up to investment. You must be very careful. I drag up to investment there because these two are calculation, isn't it? So I can control C, I copy, isn't it? Then I paste here, control V, isn't it? Then sorry, control Z. The pasting will not work because we've changed so you just go direct. So this one, so you can just take this one. So I'll be going per 3, isn't it? By everything plus this one here, enter. Then I'll drag now. So you can press control enter if you don't want it to go to the next, isn't it? So for the ordinary, isn't it? I'll take only the parent, isn't it? A free mark always. Then to loan stock equal. So this one here plus the subsidiary, isn't it? Then for payables also here equal. So the parent plus the subsidiary, isn't it? Here. So if you don't want it to move down, you just press control enter, isn't it? It remains there, then you just drag, isn't it? Just drag. So by just doing this way, there are some marks that you've already earned, isn't it? I told you that by just doing this way, there are some marks that I'll merge these ones. So you can press Alt HMC. Then maybe I'll just widen because I don't want to merge 3. Then I merge also this one here. Alt HMC, or you can just merge directly, isn't it? Control Bolt, isn't it? I also drag this one so the equipment is seen properly. And I think now I'm good, isn't it? So after doing this is where now we go to adjustments, isn't it? So maybe I can write here, this one was merged, adjustments. Adjustments, isn't it? So the first adjustment that we'll start with, obviously, goodwill. So 1, goodwill, isn't it? So remember we had been mentioned on the fair value of NCI, isn't it? So I think we just logging again. I'm just restarting the link, isn't it? We just logging again, then we start on adjustment, isn't it? We just log in again and we start on adjustment. So goodwill, isn't it? Goodwill have parent, and we also have the NCI, isn't it? So for the parent company, the goodwill will be the purchase consideration minus the share of net assets acquired, isn't it? So here is the purchase consideration minus So it had 8%, 80%, so I'll click there, isn't it? Then you multiply by, I open my brackets. The first one will be the ordinary share capital plus, remember I'll not take this retained earnings, I'll take pre-acquisition plus this one, plus another thing that I also take into consideration is the, you can see the head revaluation, isn't it, of 50 million, and this one is million, and this one is in thousand, so it will be 50,000, isn't it? 50, 1, 2, 3. Then I close the brackets, isn't it? Control, enter, control, backspace to jump to the active cell, isn't it? So I'll come to calculate the one for for NCI, isn't it? But because I'll just be using this share of net assets, I'll copy this, Control C, isn't it? Then I allow escape, isn't it? To press escape after you copy. Here equal, isn't it? So on additional information number 1 here, we've been told the fair value of non-controlling interest to purchase consideration can be estimated at the share price of S Limited that was 8 on 1st January 2019, isn't it? So how many shares does they have, isn't it? They have, in fact, they have 20% because the parent has 80%. You multiply by, so the number of shares. So to find the number of shares, it will be the ordinary shares divided by the price per share, which is 5, isn't it? And all this I'll multiply by 8, isn't it? To get the fair value of NCI, isn't it? So this one here will be the fair value of NCI, isn't it? I'll put it in brackets, isn't it? Then minus, remember, so NCI has 2%, isn't it? 20%, not 2%. Then I'll do multiply by Control V, isn't it? What I had copied. So the share capital, pre-acquisition, retained earnings, and the revaluation, isn't it? And then enter, isn't it? Then we hit impairment, isn't it? So here we've been told additional information number 5. So it is here, but it has just slow. Let me just unmerge it. Let me just merge it here. Goodwill, where relevant, has impaired by 20% on cost as at the beginning of 2022, and an additional impairment of 20% of the initial cost for the year, isn't it? So twice, isn't it? So equal 0.2, you multiply by the goodwill, isn't it? Then I just drag down, isn't it? And again, they have said an additional, isn't it, of the same 20% on cost. So it will be the same, isn't it? It will be the same. Then so accumulated goodwill, accumulated impairment. So write just impairment, isn't it? So it will be equal the parent, the previous one plus the current for the year, isn't it? Then I drag down, isn't it? I come here, I do alt equals, control enter, control bolt, isn't it? Then I just drag that way, isn't it? So the goodwill here, it will be this amount here, you less 64, isn't it? To find it is 96, isn't it? I can do this one in a box, Alt HBT, isn't it? That way. So we have completed the goodwill. We go to investment, isn't it? Investment in associate. So investment in associate you can do directly. So equal the cost, isn't it? So the cost was 300 plus pre-acquisition retained earnings, the share, isn't it? So it will be 0.3, isn't it? Because it only invested 30%, isn't it? You multiply by, I'll open my bracket, share of post-acquisition. So it will be what was reported minus the previous one, isn't it? I close the bracket again plus. So also the associate incurred revaluation, isn't it? So 0.3 I multiply by 25,000, isn't it? Then if we had impairment, a less impairment, isn't it? But for this question, we don't have impairment. So the value there, isn't it? We find that it is 358,500, isn't it? Then maybe here under investment, isn't it? Because you see the subsidiary also had investment. We will remove, so the investment, because we have represented the subsidiary as goodwill and also investment in A, isn't it? So we'll remove the investments there minus the investments that were done. So we have the 750, then minus the 300, minus the 25 million, isn't it? 25, 1, 2, 3 in loan stock, isn't it? Enter. We'll get it at 60,000. So we also remove the 25 in the loan stock. We remove intergroup loans, isn't it? 25,000 that way. Then so we've done these ones. We've done also. So we proceed. So we are still under additional information number 1 here. As you can see on the date of acquisition, the value. So this 50 million will result into revaluation gain, isn't it? So revaluation gain, 50 million, isn't it? So it will be like 50,000 because you are working in thousand, isn't it? This one, remember, revaluation gain, isn't it? So it will be added to our PPE, just add it directly, isn't it? And now remember, because it's a gain, it means we have a depreciation under charge, isn't it? Depreciation under charge. It means you have a depreciation under charge. So we'll confirm the addition, the information on it. So it says on the date of acquisition, of which it is 2019, 1st January 2019, isn't it? The values were by 50 million and building are depreciated at the rate of 2% per annum on reducing balance, isn't it? So remember it was on 1st January 2019, isn't it? So you can just start the years 2019, tab 2020, isn't it? Then this one I want it as a number with no decimals, isn't it? Then we are presenting at 2022, isn't it? So 2021, 2022, you can see we're presenting at 31st December 2022. So the depreciation was 2% per annum. So it can be written as 0.2. You multiply by the 50, isn't it? So remember it is on reducing balance. So this 150 minus 1,000 is like 49, isn't it? 49,000. You multiply by 0.02, isn't it? Then enter. Then so for 2021 equal. So I can open my bracket, isn't it? I take this 50, I press F4 to lock it, minus, then I do sum, I press tab, isn't it? The sum of these two. Then I lock the first year, the 2019, isn't it? I lock 2019 alone, I close the bracket, I close the second bracket, I multiply by 0.02, isn't it? The depreciation rate, isn't it? Then here I'll just drag, isn't it? So the total, control enter, control bolt. So I can also bold in these ones, control bolt, isn't it? The total here equal, so sum, I press tab, then I select the data there, I press enter, isn't it? Control bolt. So this is the depreciation under charge, isn't it? I lock this one in a box also, Alt HBT, So depreciation undercharge is always less from PPE, you less it directly, you less the total there, isn't it? Then we continue. So additional information number one, we can say we removed the loans, isn't it? We've done also the revaluation, the goodwill, the investment in associate, and also depreciation undercharge, isn't it? And also we talked of the fair value for this year. It means we can just say that note number one, we have completely finished it, isn't it? We go to note number two. On 1st January 2021, H Limited sold an item of land at a selling price of 75 million, reporting a profit markup of 50%. The plant is depreciated on 20% per annum. So we will have depreciation overcharge here and unrealized profit on. So here, unrealized profit on sale of fixed assets isn't equal. So 75,000, isn't it? To multiply by. So this is just the transfer value multiplied by the profit margin. But here, we've been given the markup. So markup, like it's a half, isn't it? Markup is on cost, isn't it? And remember, cost plus profit is equals to sale, isn't it? So if you have been given a markup like 50%, which is 1/2, isn't it? It means the profit is 1 while the cost is 2. So to change the cost into sales, it will be the cost plus sales. So 2 plus 1. So it becomes 1/3, isn't it? So it will be 1/3. Then we have depreciation overcharge, isn't it? Depreciation overcharge. Remember, so this one was acquired in the year 2021, isn't it? The transaction took place in the year 2021 here on January 2021, isn't it? On January 2021. So from 2021, isn't it? And it is reducing on 20%, reducing balance, it will be 0.2. You multiply by the UPFA, isn't it? Then for 2022 now, for the year that we are, isn't it? It will be so reducing balance 25 minus 5,000, so it can be 20,000. You multiply by 0.2, isn't it? So the total here, so I can just copy this one, Control C. I paste it here, Control V. Isn't it? The total here equal the 2, isn't it? This one plus this one here, isn't it? So I'll bolden this one also, Control Bold, and also I'll also bolden this one here, Control Bold, isn't it? So remember this affect our PPE. So remember this is the parent plus the subsidiary plus revaluation gain minus depreciation undercharge. So minus, we will less UPFA, then we will add depreciation overcharge, isn't it? We'll add depreciation overcharge. I think there we finished on that. I'll enclose that one, RTHBT, isn't it? Then we'll continue with the additional information. So we are here. I told you this one will be relevant. Also, this one will be relevant, isn't it? You know, this one is relevant because it applies to the prior financial period. But and this one number 2 is relevant because it's between H and A. A is an associate. We don't consolidate. So the only thing that will take here it is this one, isn't it? Which says S Limited sold to H Limited. It's an upstream 20 million at the normal. So we'll use the above here, which was a third, isn't it? At the normal gross profit margin, and a quarter of the goods remain, isn't it? So unrealized profit on closing stock equal, so 20 million, so it will be 20,000. You multiply by a third of the normal gross profit margin, what we used above. Then we also multiply by a quarter, isn't it? The ones that remained. isn't it? I'll bolden that and also to 2 decimal places, isn't it? So remember, this one is also list from our inventory, isn't it? I list directly as I go. So the good thing of doing the adjustment as you go and also presenting before you start adjustments is you have already earned some marks. Even if times lapse you up, you'll already have some marks, isn't it? You list that one. And remember, we also offer online classes at a very affordable price. So you can consider enrolling with us, and we are very thorough with the syllabus. So here I'll find the whole total sum. I press tab, isn't it? Control enter, control bold, Alt H, sorry, Control Z, Control Enter, Alt HBU, isn't it, to put the two borders down and one at the top like that, isn't it? Then we continue with our additional information. So we said we are here, isn't it? So we say this one will be affected, will only affect the opening inventory, which will be the statement of profit and loss, which we don't have, isn't it? So we'll move to number 4. Number 4, we have included in trade receivable payables. So I told you H and A, only the group, isn't it? The other one is not a group member, it's an associate, isn't it? So intergroup balances. So remember, intergroup balances will less from the receivable. So this one will go directly minus 25, 1, 2, 3, isn't it? And also trade payables will less the 25,000 minus 25, 1, 2, 3, isn't it? The adjustment, we have already entered it directly. Then, so here, a close check, isn't it? A close check in S Book Limited reveals that the receivable of S Limited had 30 million due from H. This anomaly rose because H sent a check of 5 million to S Limited on 25. So cash in transit, isn't it? So cash in transit first, we will add to our cash 5,000. So here our cash here plus 5,000. Isn't it? And we less our receivables, isn't it? Minus 5,000, isn't it? Then we go back to the question. So the goodwill part, I think we already did, isn't it? So what we are remaining with, the retained profits and NCI, and our statement will be over, isn't it? So maybe this two I want to calculate them together because they go hand in hand, isn't it? So maybe I can put them here one, like here now here. I'll do NCI, isn't it? And then somewhere here I'll do group retained and, isn't it? Then I'll put a border now, Control Z, yep, sorry. So I'll just repeat again, delete, isn't it? I'll put a border here. So Alt HBL to input a left border, isn't it? And here I can put a right border also, Alt HBR, isn't it? For a right border here, remember, this one will be merged, the opening of the account, isn't it? Here will be merged. So remember, this NCI and whatever just comes from the additional information, isn't it? So the first one was goodwill, isn't it? So remember, the goodwill of NCI will come here. That's why we separate the goodwill when calculating. So the goodwill of NCI here equal the 10,000, isn't it? Then depreciation overcharge will be on this side. So depreciation, undercharge, overcharge, undercharge will be on this side, overcharge will be on the other side, isn't it? So remember here, it goes only the percentage of NCI, isn't it? So we multiply by what the NCI will be receiving, isn't it? And the same will apply here to retained earnings, control V. But here now it will go 0.8, isn't it? We multiply by the same, isn't it? Then, so we have taken here and here also. So we go to this one, depreciation overcharge. It will be the opposite. So it will be this way. So depreciation overcharge. So the percentage also, it doesn't go the full amount equal, isn't it? So this one will go 0.2. We multiply by the depreciation overcharge of 9,000, isn't it? Then I'll copy the same thing, Control C. I paste it here, Control V, isn't it? And this one now will be 0.8, isn't it? Equal 0.8 multiply by the 9,000, isn't it? Enter. Then, so we go to UPS because the sales were upstream from the subsidiary to the parent, isn't it? It means also the subsidiary will have it, isn't it? UPS. So UPS will be equal. So it is 0.2 to multiply by. So we are at UPS multiply by this one, and the same thing will apply to the other, isn't it? Control V, isn't it? Equal 0.8 we multiply by the same UPS, isn't it? So what I'm forgetting is the impairment, isn't it? Impairment. What I was forgetting, impairment. So the impairment here, remember we separated, it would go only the impairment of NCI, and also here impairment. Impairment will go the impairment that the parent faces, the 60, isn't it? Then now I think we'll be back to this NCI. So we bring in the shares, isn't it? We bring in the net asset, isn't it? We have the share capital. We also have retained earnings. We also have revaluation. Isn't it? So the share capital, remember the percentage of NCI is 0.2. We multiply by the shares there, the share capital, ordinary shares, isn't it? Then equal 0.2. You multiply by the retained profits, isn't it? The 365, isn't it? Then revaluation. So remember the NCI it revalued by 50,000, isn't it? The 50 that was an additional information number one, isn't it? Enter, isn't it? The 50 here, the revaluation, this one, isn't it? Then I think for NCI we've finished. Then we'll go to the parent, isn't it? So to the parent, another thing that comes in here was the UPFA, isn't it? This UPFA. So UPFA will appear there. UPFA, isn't it? The whole amount equal the 25. There, it will appear there. Then, so the parent retained earnings, isn't it? Parent retained earnings. So parent. So I'll write RE for retained earnings. Parent retained earnings equal, isn't it? You go, you take the amount. So you can see it was this one here, isn't it? So post-acquisition retained earnings in subsidiary. Another thing that will enter there. in sub, isn't it? I press tab, equal sign. So the percentage 0.8 you multiply by post acquisition, isn't it? So post acquisition, you'll open your bracket, and so it will be this value minus pre-acquisition, isn't it? Of 200, isn't it? Then you close your brackets, control enter, control backspace to jump to the active cell. Then because we also post acquisition retained earnings in associate, isn't it? I'll copy this one, control C, I post it there, control V, isn't it? But not in subsidiary, so it will be in associate company, isn't it? Tab equal, isn't it? So remember the subsidiary is 0.3. You multiply by, I'll open the bracket. So I'll take this one minus the pre-acquisition, which was 300, isn't it? Then I close the brackets. Sorry, I'm not seeing cell 370 or that one there. Then I close the brackets, control, enter, control, backspace to jump to the active cell. Then remember also the revaluation in associate, isn't it? The revaluation in associate also appears here, isn't it? Equal 0.3 you multiply by, so the revaluation in associate was 25, 1, 2, 3, isn't it? Then I'll find the total here, so I can do equal sum. I press tab, the total there, control enter, control bolt, isn't it? So also for here, so I'll find 2s of p, isn't it? Retained earnings, the value that we'll be taking to statement of financial position, isn't it? So the value that we'll be taking there, it will be equal this value here minus sum. I pressed up the sum here, isn't it? I close the brackets, control enter, isn't it? And that is the value that I'll be taking there, control C, just to see the balance, but it must balance, control V, isn't it? Or let me just do sum, sorry, equal sign, sum, you press tab, then you add everything here, isn't it? Control enter, that way, isn't it? And you can now decide to unlock this one, isn't it? Alt HBT. Then now you come to the NCI, isn't it? NCI, everything was over. So equal sum, press tab, select everything, control enter, control bolt, isn't it? Then you come NCI to S of statement of profit and loss, the value that we will be taking there, isn't it? Equal. So I'll take this value minus sum, I press tab, the sum here, isn't it? I close the brackets, control enter, isn't it? So here I'll do equal sum, I press tab, I add these all, isn't it? Control enter, control bolt, isn't it? And now I can decide to also enclose that one because I've finished. And that is how we do the question, isn't it? So this one was enclosed, but let me just, so Alt HBN to remove the borders, then Alt HBT, isn't it? So it's just taking in the values. So remember here's our statement, isn't it? So if you see the spacing is a little bit higher, you can just select Control Shift plus, isn't it? Move cells to the right, Control Shift plus, move cells to the right again, isn't it? So then we bring in our 10 profits equal. So our 10 profit value is this one that we take there, isn't it? And our NCI value equal, this is the NCI value that we take there, isn't it? Then so I'll find the total equal sign, sum, I press tab, then I select everything, isn't it? Then I do control enter, control bold, alt HBU, isn't it? So the two borders there, the bottom borders, and that is how we present, isn't it? Alt HBT, isn't it? The statement is already presented, isn't it? It was as simple as that. Alt HBT, isn't it? Then I'll merge maybe these ones just to make them look nice. So this one I'll put it in the middle there, isn't it? And this one I bold it. Alt HBT, isn't it? So, and that's how we prepare the consolidated statement of profit and loss, a very simple concept. So remember, you can enroll with us. We also have pre-recorded videos, class videos. We always record all our classes, isn't it? You enroll with us. We also offer very affordable prices. Thank you for today. Today was just a recap of the April 2023 exam on group accounting, isn't it? And that is how group accounting is done. So I think the class will end there.